Welcome to Stock Talk with Nico Criticos. Today we will be going over my three big dividend stocks. And first off, I want to start with the reason that I'm invested in these three companies is because throughout this year, I've felt that the stock market is kind of in a rough place, and I feel like it's very uncertain what it's going to do in the short-term future. And I just felt like a lot of stocks had overblown valuations, and I wanted a safe place to store my money just for the next maybe 3 to 6 months, just until we have a little correction or until things in the economy look more clear. And so I wanted to put my money in some safer stocks that were going to pay me a dividend in the meantime. And normally I feel like a 1% or 2% dividend is kind of like a waste of time. So all of these stocks are going to be at least a 4% dividend. And the first one on the list is Walgreens. And I feel like this is a very safe company to be in. Walgreens is very popular. And the last couple of years, the stocks have been pushed down a lot, partly because their earnings were down, but also because there were fears that Amazon's pharmacy delivery business was going to hurt them. And I think that was a little bit too overblown, because the stock was trading at $86 a share and it went all the way down to $34 a share. So I feel like that was a little bit exaggerated. And I don't know. I think Walgreens is a pretty safe company to be in. And so if we look at the dividend, this one pays a 3.9% dividend, and the payout ratio is 72%. Payout ratio just means what percent of the company's earnings are they paying out in the form of a dividend. So 72% is kind of high, but it's definitely sustainable. It's nothing too crazy, so that's okay. And I just feel like the other thing about Walgreens is this year they should have a huge increase in sales because of all the foot traffic they're going to be having from people getting the vaccine. And Walgreens is just like a good store for anything that, whatever they sell almost everything. So a lot of things people need if they want to run in someplace and get it real quick, Walgreens is a good place to do that. Their other competitor, CVS, I don't know if I think both can coexist at the same time and both succeed. So I'm not too worried about CVS. But if we let's see, we're going to look at how many shares I bought and my cost basis. So I bought 80 shares at an average cost of $48.83. And so right now the stock has been stuck at this $48 range for at least a couple of weeks now. So it hasn't been doing much. But luckily, next month, September 10th, I will receive $40 of dividends from this company. And that's just from owning 80 shares. So that's a good example of, just receiving that passive income in the meantime. Now, for all these stocks, there's a couple of things that I check to see if I'm interested. And besides things like the dividend and the payout ratio, I also will check this whalewisdom.com, and it'll tell me how many hedge funds are holding this company. So this is the highest I've ever seen. It says that as of Q2 2021, over 1,200 funds were holding Walgreens. So that's another good example of just this being a safe company to be invested into. So there's the first one, WBA Walgreens. Now, number two is I'm going to go in order of least paying dividend to highest paying dividend. So next up is one I started buying this month, and that is BGS or B&G Foods. Now, this company is the owner of dozens of super popular food brands. I'll pull up a picture of all their different companies or all their brands. But they make things like, they just bought Crisco oils. And so that was a big investment for them. From what I've read, it sounds like they've been making lots of investments in buying new brands. Like they also bought Weber Grills. And let's see, if we look through here, we can see they have some of the ones that stand out to me are Cream of Wheat, Cinnamon Toast Crunch. What else? Weber Grills, Irish Oatmeal. There was another one on here. Ortega, Green Giant. So they just own a lot of different, frozen food brands and canned goods and a bunch of different type seasonings. They said was a big market for them. So another one that I feel safe being in, and this one is even better than Walgreens because the dividend is 6.5%, 6.4%, which is super high. And if we look at their payout ratio, we can see that. And also, what I've been noticing when I've been hearing a lot of, listening to a lot of conference calls and listening to what management has to say for guidance, it sounds like the biggest problem I see with a bunch of companies is the supply chain issues. There's a lot of high costs with shipping, and there's a lot of supply chain disruption just because of, I don't know, just different things along the supply chain that are causing them problems. And what that is doing to the company is it's not allowing them to produce enough to meet their demand. So I heard iRobot said this, and this B&G Foods said this. They're all saying the same thing. For this year, they're not going to be able to keep up with demand. But then in 2022, when things get when production goes up and the supply chain is improved, then things should be looking better. But this one trades at a super low PE of about 15 or 16, and if we look at their payout ratio, it is 112. Now that is really bad. That is normally something I would stay away from. However, the thing here with this one is, how I said, I think earnings are going to go back up next year when these supply chain issues are fixed. And so this isn't like a company that I'm worried is going to go out of business or something, because they own all those popular brands and people are going to keep buying those. So I'm not too worried about that. I think they said they're expecting to do, I want to say $200 million of earnings for this year. And as you can see, they did 130 million last year. So that should improve their payout ratio, so it's not so high. But for this one, B&G Foods, I bought, I want to say, I forgot how many shares, but I bought $2,000 worth at an average cost of $29 a share. And if we look at the stock price here, we can see that stock price is down a decent amount from where it has traded at in the past. In the past, it's been up to $50 a share. When the pandemic came, it went down to 13, and now we're at 29. So it's been, for the past year, it's been at this $29 range. So just another safe company. They have lots of popular brands. I don't see them going anywhere. Other thing we can check here is on this website for how many funds hold them. And this one has 283 funds holding them, which is low compared to Walgreens, but compared to a lot of the companies I check on here, 283 funds is actually a lot. That's a lot of funds holding this company. So see, they own Cream of Wheat, Crisco, Dash, Green Giant, Maple Grove Farms, just a bunch of popular brands. Okay, then our final one is going to be another new one I started buying about a month ago, and this is the highest paying dividend one. But this one I bought a lot less of. I didn't buy that much just because once you see the stock chart, you'll understand. So dividend 7.7%. That is huge. Payout ratio is 49%. So actually the lowest of the three companies, but paying the highest dividend yield, which is fantastic. This company, again, trades at extremely low PE ratio of 7. But here's the problem. If we look at the stock chart, we can see that it has not really dipped. It's pretty much just been up and away, especially Over the past year, it's up 59%. And it was at $11 and now it's at 18. That's why I'm buying this one extremely slowly, because I'm just waiting for it to dip down to 15 or 15, 14, whatever. And then I'm going to buy, then I'll buy a bigger stake. But this is, if you want to see more about this, I posted a video 2 weeks ago called Comparing 5 Big Dividend REIT Stocks. And I do that. And this ABR, Arbor Realty Trust, it turns out that one has the best metrics. And so that's the one that I picked as the best dividend REIT stock. So that's Arbor Realty Trust. Then if we look up how many hedge funds are holding them, we see that it's 233. So same thing. That's a decent amount of funds. That's pretty high. So that's a good sign there. Now, the thing is, they did say the majority of they own a little over $5 billion worth of properties. And they also give out loans. So that's their business. And the thing though, I was looking through their reports, and the thing though was most of their properties are in, oh, and by the way, the market cap for this company is $2.5 billion. And so they own a little over $5 billion worth of property. But the thing is, they own it mostly in New York. And then I believe it was in Texas, and they own a decent amount in Florida. And so Florida and Texas are a good sign, because I think that's where a lot of people are moving. But I don't know if it's a good thing that they own the majority in New York, because we know that a lot of people were moving out of the cities, and people don't really need to live in the cities as much as they did before, because now they can work from home. So that's just something to consider. However, if we look at their actually, I like checking on this website better. But if we look at their revenue and profit growth, we could see that they've done fantastic over the last however many years, ever since 2014. Really, these look how much revenue has grown from $92 million of revenue to $430 million of revenue. Earnings went from 53 million to 170 million. So fantastic job by management there, because earnings and profits just keep growing up, or keep going up. And even through 2020, when the pandemic hit, they still did a great job doing that. So it looks like a great company in a great position. I am expecting real estate prices to drop eventually, at least a little bit. Maybe we have some permanent inflation, but I don't think it's going to stay this elevated forever. We have to see a dip, both in the real estate market and in the stock market. So when that happens, then yeah, that's probably going to hurt their business. And maybe that's when the stock will drop 15 or 20%. And that will be a good opportunity to buy this stock. So that's Arbor Realty Trust. And this one, we go down here, we can see same thing with this one. I own it at, my cost basis is $18 a share, so it hasn't really moved much. Just put $1,000 in, because how I said, I'm buying slowly. And then next week I'll be getting a $14 dividend, and that's only from $1,000 investment, so that's pretty good. And so yeah, those are my 3 big dividend stocks: Walgreens, B&G Foods, and Arbor Realty Trust. And if you wanted to see the valuation on Walgreens, we know that the stock price is down over the last couple of years, but the PE ratio is also very low. Trailing PE of 18, but since they're expecting earnings to go up, the forward PE is only a 9, which is extremely low. Price to sales of 0.29. You can't ask for more than that. It's going to be hard to find cheaper than that. So yeah, those are my big dividend stocks. And if you're looking to make some good passive income, then these companies might be the perfect way to do it. Thank you for watching.